Hey, what's up, everybody? It's Matthew Mickey here. I wanted to start this class off by telling you why I started studying, journaling, and trading the financial markets. Like every good story, I'll start it off like this. No shit, there I was. Deploying back to back to magnificent countries like Iraq and Afghanistan for a period of 6 months, 12 months, 15 months. And I would watch the most amazing actions being conducted by my barrel-chested freedom fighters and free soldiers, and I'd watch them save up a good amount of money, 5,000, 20,000, 10,000. Why? Because they had nothing to spend their money on, or had a location to spend their money at. So when we would return home, I would give them financial classes like, hey, don't be an idiot and blow this money. Invest it, throw it in a mutual fund, pay off debt, save it. But for the love of God, do not blow it on strippers, partying, and expensive cars that you can't afford 6 months from now. And, then a month would go by and I would notice very jazzy looking cars showing up in the parking lot. And I would notice when I would do my nightly checks that my soldiers would have brand new big screens and wearing the newest Jordans. So I'd bring them all together and be like, hey guys, I told you not to be an idiot. You guys are being idiots. What did you spend your money on? And about 1% of them would say, I invested it. And that was pretty cool to me. And I would ask them what they invested in. And they told me that it was, a stock, the stock of the day off of CNBC, like eBay or Nike or whatever. And I thought that was pretty cool because I was ignorant. And then I would ask them a couple weeks and they'd be like, Sarge, we got smoked. And that pissed me off, because they would have been better off just blowing their money in Vegas. And so, because I understood the blood, sweat, and tears literally required for those soldiers to make that savings account. So that led to me studying and doing all this stuff. And I realized quick, fast, and in a hurry that they didn't take it as a profession, and they didn't take it serious, and they thought of it as gambling and a free lunch and an easy way to make a buck. And, they went up against the biggest and the smartest market in the world. So that's the whole purpose of this nonprofit, is to take those studies that I've done over the last decade and apply it in a way to teach the working class to be better stewards of the funds, to understand the financial markets from a systematic standpoint, data-driven standpoint, and then, to kind of lead, still soldiers. So the last class we talked about the critical benefits of calculating your odds through distribution, and saw that this will paint a clear picture of historical volatility. And historical volatility tells us the different opportunities in an asset over a time horizon. Now we know the importance of calculating future volatility, because anything you compare and contrast, you got to have a projection, a forecast, or a thesis on what you think is going to happen. So don't think about volatility as a bad thing, right? Because it gives you the ability to see the expected opportunities and how to manage your risk, like where to place your stop losses or limit orders, or et cetera, right? Volatility shows us that how our assets are going to perform within the next 30 or whatever timeline that we're measuring the volatility for, implied volatility for, right? So for example, if volatility is projected to increase in the next 30 days, we have our first decision point to make. We know that volatility increases, that provides us with short-term opportunity to the upside or the downside or both sides. But it's more than likely volatility increase will stem from a macroeconomic standpoint, maybe a Federal Reserve action, fundamentals from the asset, news related, the headline risk, or changes to the business product of that asset, right? And this is why we study, and I set this up the way I have, because we start off with liquidity from the Federal Reserve and understanding how that all works. Then we learn how to get a worldly view to the macroeconomic part. Then we go down to the industrial view. Then we are now at this step that we're studying first, right? And so now, because we studied all that stuff, we know what the driver for the volatility is. Because, like I said, volatility increase means it can go up or down. It doesn't mean it's just going to drop the price of the asset. So now, what we do know is when volatility is falling, the asset class short-term volatility starts to disappear, and we need to make the decision to go from a day trade prop trader mindset, short-term trader mindset, to a portfolio manager mindset. And I will teach you how to build the Excel spreadsheets to figure all this out for any asset class in the workshop videos. I'll walk you through how to build a volatility profile for every asset using Excel, and guess what? Free data. Alright, so this way we can get the grubby hands of that paid signal service off your $100 a month that they charge you because they don't know how to trade, or they are too lazy to study to learn how to trade, and all they do is hunt for high turnover rates of customers. But I digress. So implied volatility is a component of the volatility profile of the assets that we're seeking opportunities in. And the market tells you based on what your opportunities are going to be and what they're not going to be based off of that volatility profile. What we talked about in the last video was, for example, historical volatility. The S&P 500 is the biggest market in the world, and the VIX measures the implied volatility of the S&P 500 options, right? And the VIX is quoted in percentage points, right? And is the expected movement of the S&P 500 over the next 30 days, which is annualized, right? So, for example, the VIX is at 15. This represents an expected annualized change of 15% over the next 30 days. Now, the S&P option market expects that the S&P 500 will move up or down based off that 15% annualized, which comes out to be 4.33% over the next 30 days. So the index options are priced with the assumptions of a normal distribution, one standard deviation, that 68% likelihood that the change will be up or down will be less than 4.33%. So why am I talking about something that's related to options? Right? The price of options are used to calculate implied volatility because volatility is one of the factors used to calculate their value. Higher and lower volatility of the underlying sector makes an option more or less valuable because if there's high volatility, there's a greater probability the option will expire in the money or out of the money. If there's low volatility and you have an in the money option long, then it's going to be worth more because the odds of it falling out of the money are slim to none. Now, time plays a huge role in that, and we'll get into that during the options part of this course, right? All right, so volatility is a trader's best friend and a portfolio's manager's worst enemy, right? Because it tells you the expectation of what the move is going to be. Like, increased volatility provides us short-term trading opportunities, and less volatility provides us less short-term trading opportunities, such as day trading, prop trading. But overall, traders in general are slaves to volatility, and that's what blows my mind, is that not many people focus on it. So listen. No volatility, no short-term trade. Professional traders know this, and they adjust their plans to that. So, volatility for a portfolio manager looks like this. When volatility increases by a large percentage in an aggressive manner, they de-risk. They de-risk and they go to smaller positions. That way, this opens up cash, right? And we'll talk about what they use that cash for in a minute. All right, so historical volatility is the beast and how the beast behaves. Implied volatility is how we expect the beast to behave in the future. So let's say I'm in Afghanistan with my platoon war fighters, and being on the offense, going out and seeking the enemy because the enemy isn't attacking us and we're not getting intel on the enemy's location. So we have to constantly patrol, constantly go talk to villagers, constantly, do reconnaissance to try to find them. That would be a low volatility area, right? Now, let's say every day the enemy is hitting us and the enemy is, tracking our location, and every day we get a village elder come to our defensive position and, tell us where the enemy's at, right? So now we're in a higher volatility time frame, right? And there's no need for us to take the risk of going on patrol. We need to bunker down and be in a defensive position. Now, there's a lot of more variables that go into that, and that's just an easy example. I'm not saying that's how we do it, but it's to break it down for you, right? So we saw that 80% of the time in the S&P 500 over the last 60, 50 years, the beast was asleep. So as a prop trader, as a professional trader, which one do you want to be during that time? And which kind of trader do you want to be the 20% of the time that volatility and the beast is awake? So for example, let's say we have a $10,000 portfolio. We put $5,000 long stocks in the S&P and $5,000 short stocks in the S&P, with 5% position sizes each being $500. For a normal day, the 80% of the time that we saw from historical volatility, our profit loss will be roughly 0.35%, or we can do it like this: 10,000 times 0.0035 equals $35. All right, now let's say expected volatility, implied volatility, doubles. Let's say from 6% to 12% annualized. Our profit lost, our risk doubles, right? So from $35 to $70, right? Meaning that there's always going to be risk, but you can use volatility to know how you should be trading. So when volatility increases, decrease position sizing and reduce risk, right? Two concepts that, I failed to learn as a young trader was, number one, I don't trade, risk mitigation, right? So it blows my mind that people will try to sell programs that tell you that you can trade for income and make $10,000 a month, right? Because the whole purpose of trading and investing is to have more income and to take that profit and compound it, which allows you to execute more risk. If you're making money, you should be able to utilize more risk. If you're not making money, you have to use less risk. If you're losing money, less risk, right? And then not managing your risk at the correct time based off of volatility. So now that we know that we should reduce our exposures during high volatility times, we have a bigger cash exposure. Now we can trade, we have cash to trade short-term opportunities, day trades and such. So if the VIX goes up by 25%, this means portfolio risk across the entire world just went up 25%. And it takes the size traders a while to de-risk due to the lack of available liquidity in the market, right? This is where our edge as a retail trader comes in. It is almost it's almost April right now, and funds are still de-risking after the VIX jumped almost 3 months ago, and the S&P 500 has been fading slowly the whole time. And that's how this is our edge, right? So think of it like this: we get 3 days beforehand to set up a class 4 defensive fighting position and have the time to set up obstacles and hide logistic caches around the area of operation, and to do whatever we have to do to funnel the enemy into our kill zone before they are even told the intel that we are in their sector. Now, so you have to look at the VIX as a green light, yellow light, red light system. And I'm not saying there's a rule book out there, because there are no rules. It is up to your own personal risk style, and because you're the one that has to take the trades. I will tell you this, though. It'd be wise for your portfolio to always have them ranked by criteria that we'll talk about in future classes. So you always know what to de-risk if you wake up one day and VIX jump 25%. Lastly, take messages from your loss. What is the market telling you? If you're day trading because volatility is high, implied volatility is high, and it becomes harder to make money, the VIX is slowly creeping down, along with whatever world view or industrial view you're seeing from your other analysis. Maybe you stop day trading and start the ideal generation for you to get good entries in your portfolio, because the market's shifting. So the last thing is, the VIX is not a fear index, no matter what they tell you. People misuse this term because it relates to the market has to go down when it hits a certain percentage, right? However, if you look back in 2003, the VIX was through the roof, and everybody feared that a worse move was coming, and everybody was shorted, and that was the beginning of a bear market, right? You can call it the fear of being wrong, either way index. Now, let's finally talk about, should you hedge when the volatility jumps? That's up to you. It depends on the style of trader and where you are with your portfolio, whether you take delta neutral hedge, whether you're beta neutral hedging, whether you use the VIX to hedge with. But for me, every opportunity is different, and where I am based off of my risk, which changes every single day, right? Based off of my analysis. But I will tell you this: if you decide to hedge your long-term portfolio, you're locking up all your cash, because hedging is expensive, for the short-term opportunities, and you're missing out on them. So hopefully this helped, guys. Thanks for listening. Later.